What's going on, everyone? Sebastian here with Crypto News, bringing you the best crypto content on a daily basis. Today, we're going to explain exactly what yield farming is and how you can get in on this booming incentive that the crypto markets have developed to bring more liquidity as fast as possible through the entire crypto ecosystem. Now, yield farming is so particularly appealing because it simply allows people to earn passive income simply by staking their LP tokens. And some of the most popular DeFi lending and borrowing protocols are attracting billions of dollars in liquidity simply because they're allowing people to earn a much higher APR or APY than compared to sticking their cash in a bank and earning less than 1%. So all of these juicy APRs are just attracting liquidity all over the world, and this is the very basic understanding of just exactly what yield farming is. On top of that, more complex strategies have developed in yield farming that now allow users to do so many different things and earn token rewards based on LP tokens and just basically different ways they can navigate their LP tokens and mine more liquidity. So odds are you've probably heard of liquidity mining if you've been in crypto for any amount of time. And in this video, I'm going to take you through some of the potential pitfalls, but also all of the advantages that yield farming has and how you can take advantage of those advantages in yield farming today. Now remember folks, this video is not financial advice. I'm not a financial advisor, so please do your own research anytime you invest in any sort of cryptocurrency. This video is strictly for educational purposes only. And if this is your first time watching one of my videos, drop me a comment below and let me know what you think about this video. I love to see who exactly my viewers are and what they think about the content I release. This allows me to continually push content that you guys want to see. DeFi has become one of the hottest topics I've talked about on this channel, and it doesn't seem to come as a surprise as the decentralized finance space has been booming recently. It is a fertile ground for new innovations using blockchain technology. The uniqueness of DeFi apps lies in their permissionless nature, meaning that every crypto user can engage with them. Also, DeFi is trustless and eliminates the need for intermediaries in transactions. Investors have been making a killing by investing in DeFi projects, but with the many indicators that they need to check out before investing, they sometimes miss out on amazing opportunities. But a new investment concept known as yield farming has come into existence. It allows investors to earn token rewards by investing their funds in liquidity protocols. With yield farming, crypto users can earn passively, and this may change how investors hold assets in the future. So what is DeFi yield farming? Also referred to as liquidity mining, yield farming is a way to generate rewards with cryptocurrency holdings. In simple terms, it means locking up cryptocurrencies and getting rewards. In some sense, yield farming can be equated to staking. However, there's a lot of complexity going on in the background. In many cases, it works with users called liquidity providers that add funds to liquidity pools. A liquidity pool is basically a smart contract that contains funds. In return for providing liquidity to the pool, LPs get a reward. That reward may come from fees generated by the underlying DeFi platform or some other source. Some liquidity pools pay their rewards in multiple tokens. Those reward tokens may be deposited to other liquidity pools to earn rewards there, and so on. You can already see how incredibly complex strategies can emerge quite quickly. But the basic idea is that a liquidity provider deposits funds into a liquidity pool and earn rewards in return. Yield farming is typically done using ERC20 tokens on Ethereum, and the rewards are usually also a type of ERC20 token. However, this may change in the future as other blockchains will begin to host more liquidity pools. Furthermore, cross-chain bridges and other similar advancements may allow DeFi applications to become blockchain agnostic in the future. This means that they could run on other blockchains that also support smart contract capabilities. Yield farmers will typically move their funds around quite a lot between different protocols in search of high yields. As a result, DeFi platforms may also provide other economic incentives to attract more capital to their platform. Just like on centralized exchanges, liquidity tends to attract more liquidity. Now let's talk about how DeFi yield farming works. Yield farming works with a liquidity provider and a liquidity pool that powers a DeFi market. A liquidity provider is an investor who deposits funds into a smart contract. The liquidity pool is a smart contract filled with cash. Yield farming functions based on the automated market maker (AMM) model. This model is popular on decentralized exchanges. AMM eliminates the conventional order book, which contains all buy and sell orders on a cryptocurrency exchange. Instead of stating the price that an asset is set to trade at, an AMM creates liquidity pools using smart contracts. These pools execute trades based on predetermined algorithms. The AMM model relies heavily on liquidity providers who deposit funds into liquidity pools. These pools are the bedrock of most DeFi marketplaces where users borrow, lend, and swap tokens. DeFi users pay trading fees to the marketplace, and the marketplace shares the fees with LPs based on their share of the pool's liquidity. Take Compound, for instance. The protocol provides liquidity to borrowers who want to borrow crypto funds. The Compound finance system does this using smart contracts on the Ethereum blockchain. LPs deposit funds into the liquidity pools, then these smart contracts serve as the matching engine for market participants. Once an interest rate for the loan has been agreed upon, the borrower gets the funds. In exchange for their funds, LPs get Compound Finance's native tokens, COMP. They also get a cut of the interest that the borrowers pay. Some of the most common DeFi-related stablecoins include USDT, DAI, USDC, and BUSD. Some protocols can also mint tokens, which represent your deposited coins in the system. For instance, a user who deposits ETH into Compound Finance gets CETH, and a DAI deposit yields CDAI. So how do you now calculate yield farming returns? Typically, the estimated yield farming returns are calculated annually. This estimates the returns that you could expect over the course of a year. Some commonly used metrics are annual percentage rate, APR, and annual percentage yield, APY. The difference between them is that APR doesn't take into account the effect of compounding, while APY does. Compounding in this case means directly reinvesting profits to generate more returns. However, it is worth noting that some platforms may use APR and APY interchangeably. It's also worth keeping in mind that these are only estimations and projections. Even short-term rewards are quite difficult to estimate accurately. This is because yield farming is a highly competitive and fast-paced market, and the rewards can fluctuate rapidly. If a yield farming strategy works for a while, many farmers will jump on the opportunity and it may stop yielding high returns. As APR and APY come from the legacy markets, DeFi may need to find its own metrics for calculating returns. Due to the fast-paced nature of DeFi, weekly or even daily estimated returns may make more sense. Now, let's discuss some of the risks involved in yield farming. Truth be told, yield farming isn't that simple. The most profitable yield farming strategies are highly complex and only recommended for advanced users. In addition, yield farming is generally more suited to those that have a lot of capital to deploy. For instance, whales. Since yield farming isn't that easy as it seems, users who do not understand how it works will likely lose money. For example, their collateral can be liquidated. But there are other risks that liquidity providers need to take note of. One of the major risks of yield farming is smart contracts. Due to the nature of DeFi, many protocols are built and developed by small teams with limited budgets, thereby increasing the risks of smart contract bugs. Even in the case of bigger protocols that are audited by reputable auditing firms, vulnerabilities and bugs are discovered all the time. Due to the immutable nature of blockchain, this can lead to the loss of user funds. You need to take this into account when locking your funds into a smart contract. Another risk that DeFi yield farmers face is composability. As mentioned before, DeFi protocols are permissionless. and can seamlessly integrate with each other. This means that the entire DeFi ecosystem is heavily reliant on each of its building blocks. This is what it means for decentralized finance applications to be composable. They can easily work together. This is a big risk because if one of the building blocks doesn't work as intended, the whole ecosystem may suffer. It poses one of the greatest risks to yield farmers and liquidity pools. You not only have to trust the protocol you deposit your funds to, but also the others that it relies upon. Now, let's talk about actually implementing yield farming strategies. A yield farming strategy aims to generate a high return on investment. The steps will involve lending, borrowing, supplying capital to liquidity pools, or staking LP tokens. A straightforward way of getting APY on your capital is through lending and borrowing. For example, the farmer can supply a stablecoin like DAI on a lending platform and start to get some returns on their capital. With liquidity and leverage, they can then take that to the next level. By supplying coins to one of the liquidity pools, a yield farmer can be rewarded with fees that are charged for swapping different tokens. With liquidity mining, they can boost that return again to gain extra tokens. Some of the DeFi protocols will incentivize the farmer even more by allowing them to stake their liquidity provider tokens, representing their participation in a liquidity pool. Overall, it is worth noting that most financial market strategies can quickly become obsolete due to changes in protocols or incentives. So it is essential to keep on top of it every day and amend your tactics accordingly. Well, thank you so much for watching. I hope you found this video very resourceful. If you have any comments at all or any questions about yield farming, drop them in the comments below. I would love to know exactly what your questions are and also what your experiences are in yield farming. You've probably heard of yield farming, and more than likely you've even probably dabbled into it by now. So if you have, please share your experiences in the comments below. I would just love to know what type of experience you've had with yield farming and how it's affected your crypto trading strategy. Also, if you did find this video resourceful, please smash that like button. It really helps support this channel. Well, thank you again for watching. I'll see you all on tomorrow's video.